Good afternoon, everybody, and welcome to today's webinar. We're going to be talking about charitable gift annuities, and we're very appreciative that you've taken time out of your day to join us and be with us today. This is a webinar for professional advisors, but also potentially donors and other interested parties. And we're giving everybody a minute or two here just to log on, and we'll get started in just about 30 seconds or so. So thanks so much for joining us. Okay, well, I think we're ready to get started. And once again, thank you so much for taking time out of your day. My name is Steve Jewell. I work with CommunityGiving. And we very much appreciate you tuning in to learn more about and maybe just to refresh your memory about charitable gift annuities. With the low interest rate environment, and over the years when we've had this kind of a low interest rate environment, we've seen greater interest as well as donors who have set up charitable gift annuities to benefit their favorite charities. And as a collection of community foundations serving our area, we are here to provide services and support to professional advisors who we see as one of our key partners as we help people achieve their charitable goals and give back to their local communities. So thank you so much for joining us. We will be going over this topic, and we will be recording the session. We know we had a number of advisors and others who have said, you know, this is kind of a busy time because October 15th is coming up, but they're looking forward to getting a copy of the recording, which we will make available to everybody. And so they will be watching that later. And if you need to step out, you will also get a copy so you can watch this later. We do want you to ask questions as we go along. Just put your questions in the Q&A tab at the bottom. Some of our speakers may answer those while we're in the presentations. Otherwise, we will get to a point in the meeting where we will facilitate questions, and we welcome your questions as we go through this topic. So once again, welcome. Glad to have you with us today, and I'm going to turn it over to the Executive Director of the Central Minnesota Community Foundation, Carol Turnow, who will introduce our first speaker.
Thank you, Steve. It's my pleasure to introduce Brad Hanson. He is an attorney with Quinn, Livin & Hughes. He specializes in nonprofit law as well as estate planning. So Brad, we'll turn it over to you.
Okay. Well, I've got some slides here that I'm going to run through relatively quickly. My job is to kind of introduce you to the legal and tax concepts of a charitable gift annuity, and then I'll turn it over to some others to talk about more of the practical aspects. Well, a gift annuity is a contract, essentially. The donor contributes cash or securities, other property to the charity, and the charity agrees in the contract to pay a fixed sum each year for a period of time, and the period of time is basically 1 or 2 lives. So it's a little different than some of the other vehicles around. It is truly a life annuity, and the annuity can begin right away and start getting payments right away, or it can be deferred for a period of time. And that'll have to do with what the donor's real intent is with the gift, and what their need for income is, the timing for the income. It might actually have to do with the age of the donor, which we'll talk about in a little bit. And the interest rates, Steve alluded to the interest rate environment, which is pretty low. And gift annuities don't have any legally required gift rate, but generally charities are going to use the gift rates published by the American Council on Gift Annuities. They're designed to be conservative so that the charity is designed, if everybody lives their normal life expectancy and you get a normal rate of return on a conservative investment portfolio, they're designed to have roughly half of the annuity left over for the charity. But that doesn't always work out, but at least that's how they set them. And those rates, I think I've got an example. I think right now, as of the rate, the 65-year-old rate is 4.2%, and then the rates go up as people get older. But we'll talk about, why don't you move to the next screen. Okay, so this is the basic legal requirements for a gift annuity. I put down the tax code sections that relate to it there. Essentially, a portion of the amount that you give to the charity is going to be tax deductible. And there's a standard for that. It has to be at least 10% that's left over with the charity. So in other words, the person that's donating the money, they're going to get payments. Let's say it's an immediate annuity for just themselves, and they're going to get payments over their life expectancy. And those payments cannot exceed 90% of what they put in the first place. So the younger you are, the harder it is to meet that 10% standard. So we don't see annuities for people that are too young because they get too much back. So anyway, that's the legal requirement. It's got to be at least 10% left over at the end for the charity based on actuarial tables and the life expectancy of the donors. The next bullet talks about the fact that it's got to be one or two people, but they have to be alive at the time you set up the annuity. So because they're going to figure annuity or actuarial tables based on life expectancies, they have to be real people that are alive. The annuity doesn't have to start right away, but these people have to be alive at the time the annuity gets set up. And then the next two bullets have to do with the type of annuity it is and how it's really kind of different from maybe a commercial annuity, which might have a period certain or a certain amount. So the annuity can't have a guaranteed minimum or maximum amount of payment. So you put $100,000 in, you're going to get paid for life. And it could be more or less than that you get back based on how old you live. So there's no minimum on it, there's no maximum on it. And then finally, you can't adjust it for the underlying performance of the asset. So if you put $100,000 with the charity and the charity is going to invest it, they're going to put it in a reserve and they're going to invest it a certain way for a certain period of time. And those investments will just earn what they earn. And because the annuity is locked in, it's locked in, getting a certain set amount that they get every year. And you could end up, the donor could end up winning on the deal where you get paid more than what you put in which case it's not so good for the charity. But the donor could die the next day, and then it all goes to the charity. It is truly a life annuity, and it doesn't matter how the underlying investments go. And those are the requirements of these code sections. And then I threw in here some securities law requirements. Every state deals with annuities differently. And like I said at the very beginning, it's a contract. So it's a contract between the charity and the donor. The donor is really investing in the charity, so to speak. So the charity, it is, you're buying an interest in the charity. And if the charity goes down, the donor loses their money. So there's a security issue there. And Minnesota basically exempts gift annuities from the regular security regulations as long as they meet these three requirements. It has to be a 501c3 organization. Can't be a private foundation. It's got to be a public charity. It's got to have a minimum number of unrestricted assets, 300,000. Not too hard to beat, but it can't be just a startup with not any assets. And it's got to be at least 3 years old. So basically, at least 300,000 of unrestricted assets, 3 years of an existence, and it needs to be a public charity. So those aren't too hard to meet. Most charities around here can meet it, and certainly the community foundation meets those requirements. So you don't have to register with Minnesota securities regulations. And I'll just point out that this all works if you have a Minnesota donor for a Minnesota charity, but if the community foundation or one of the advisors on the line has a client in California, for example, that wants to make a gift annuity to a Minnesota charity, well, you got to comply with the California securities regulation laws, and they're different. In fact, California requires the charity to register out there and pay a fee, so we often don't see that. That would be an example of when we might switch somebody from a charitable gift annuity to a charitable annuity trust, which is not subject to those securities laws. In fact, we've done that. I've done that for some other charities that have had donors from other states that required registration requirements, and the charity just didn't want to go to the trouble of registering in those other states. But in Minnesota, it's pretty easy. So let's go to the next screen. So these are basically the tax advantages of gift annuity. You get a current income tax deduction. In the second bullet, kind of give you the basic calculation. It's the value of the property you put in minus the value of what you're going to get paid out for your 1 or 2 lives. So they compute the present value of those future payments, and they subtract that from the value of the property that went in the first place, and that's the deduction amount. And that's the part that has to be at least 10%, as we talked about before. And then the payments themselves, the next few bullets talk about that. Each payment you get is going to be, I guess the next bullet I talk about is capital gains. You can avoid immediate capital gains. You don't avoid all capital gains if you put in, say, appreciated stock. You're going to pay capital gains sometime, but it's going to get stretched over the period of time. So you do get a current income tax deduction, and you do not have a current full capital gain tax if you're putting in appreciated property. So it's got a tax advantage with that. Each payment is part return of basis, which is the money you put in, and part ordinary income, because you're getting this income stream over a period of time. And then if it happens to be an appreciated assets that you put in, part of that return of basis is going to be capital gains, but it gets stretched out over each payment. Each payment could have a tax-free return of basis, could have some ordinary income that you have to put on your tax return, and could have some capital gain that goes in at a little better tax rate. So each payment has those components to it. If you just give cash, then you don't have any capital gain issue. It's just ordinary income and return of basis. And that's the simplest gift to give. But it is a way to stretch capital gains tax over a period of time. So it's got an installment sale component to it if you put appreciated property in. And then finally, the bullet point I mentioned there is to remove the property from the estate. Let's just take an example that you have a donor and a donor's wife or spouse, and the two of them contribute to the community foundation and they get their payment stream back. Well, when the donor dies, it'll continue for the spouse. And if they're married, they get a marital deduction. So it might be included in the estate, but there's no marital deduction for that portion of it that goes to the spouse, or there's no tax because there's a marital deduction. And then obviously the part that goes to charity when that spouse dies, it's a charitable deduction. So it might go on the tax return, but there will be a marital deduction and a charitable deduction that offsets any tax against it. So it essentially gets it out of your estate. If you gave it to somebody other than a spouse, maybe you're an unmarried couple, or maybe it's just a child, then there's a gift component to it. So that the donor sets up this donor advised, or this gift annuity, and the gift annuity comes back to the donor for life, and then it continues for this other unmarried person. Well, that's a gift between the donor and that person, and so there would be a gift tax implication at the time the donor makes the gift, and that portion of it might actually be on an estate tax return, that gift part. So anyway, that's there's some gift and estate tax issues, but you generally, when you're using yourself or just you and your spouse, you're not going to pay any estate tax or gift tax on setting the thing up or when you die. So you can go to the next screen. So this is kind of how I'm finishing, is talking about it from a charity standpoint. From a donor standpoint, we talked about how simple it is. You just make your gift, and the charity does all the work, and you just get your payment, whether it starts now or whether it starts in the future. But from a charity standpoint, they're sticking their neck out. The charity is taking a risk because the charity is obligated under the annuity contract, depending on no matter how those underlying assets perform. So if the $100,000 going in gets invested and then goes down to zero, they still have to make payments to that donor until the donor dies. And that, I just pointed out a CRUT and a CRAT. Those are different ways of making charitable gifts that don't have that risk for the charity. The Charitable Remainder Unit Trust and the Charitable Remainder Annuity Trust are both trusts in the sense that the money just belongs to the trust, and if the money runs out, the trust runs out, and the donor stops getting paid. But the charity isn't out any money because there's a buffer. The trust is a buffer between the donor and the charity. So when there's a gift annuity, the charity is actually making a contract and they're agreeing to make the payments for the life of those two people. And it doesn't matter how the underlying assets perform, and it doesn't matter how long they live. So you could have somebody live to 110 years old. They basically pay out the whole thing, and the charity just has to keep paying. So either the underlying assets perform poorly, or the person lives too long. But those are potential risks that a charity has when they take this on. And then it's just an administrative, more of an administrative burden for a charity. Carol maybe can talk about what they do internally. And that's why charities like to have a lot of them, because the more you have, the more you can spread that administration over a lot of different payments that go out to people. But the charity has to, if they just give $100,000, it's easy. The charity just has the money, can use it for its purpose. But if the money's coming in and it has to get paid out under certain schedules and certain reporting schedules, it's just more work for the charity. And that very last bullet I've mentioned, it has to do with the security law issue again. There's a federal law that requires a disclosure statement that go to the donor, because the donor is essentially investing in the charity. If the charity goes down, the donor loses their investment. So the charity has to provide, or the foundation provides a statement to the donors saying, well, these are how many assets that the foundation has. This is how we invest them. This is our investment policy, our spending policy. They kind of lay out for the donor why it's not such a bad risk to be putting it with Community Foundation. And so anyway, this last screen is kind of from a charity perspective, what they're getting themselves into. From a donor perspective, it's very simple, and that's why a lot of people should consider it, because it's a nice way of doing it. Well, then I guess that's kind of really what I was going to speak about. I think the next screen is an example that, Carol, do you want to go through that for people?
Absolutely, very happy to. Yes, we use a system called Crescendo for our planned gifts, and actually for donors of yours, if they like, they can go onto the website. You can play around with that and enter in a dollar amount, and it would show what the payout amounts would be on it. But for a more sophisticated information, you can actually contact us and we can prepare a packet for you for the donors. So I've done an example here of Sam and Sandy Jones, who had $100,000 that they put into a charitable gift annuity. You can see their ages as 75 and 74. So it shows that 88.2% of their gift is tax-free. And the annuity on an annual basis is $4,600 then. It also breaks it down further by showing that how much of their payment is ordinary income. This example was just cash, so there is no capital gains on it. And then the portion of it that's tax-free for them. For simplicity at the foundation, there is the ability to go monthly, quarterly, semi-annual, or annual. We usually suggest quarterly, semi-annual, or annual. And we try to schedule all of those to be at the end of the quarter, March, June, September, and December for ease, so that we're kind of processing all of these at the same time when possible. So I do have a 9-page packet of this sample so that you could actually see what a donor would get if you wanted to use that service from us. And if you're interested in receiving that, because there's a lot of words on it, we didn't want to put it on the screen, but you can email us at admin@communitygiving.org, and we'd be happy to send you out that sample for you to review. Thanks, and I believe we're turning it over to Holly next.
All right, thank you, Carol, and thanks, Brad. So I'd like to introduce our next presenter, who is Josh Tachi. And Josh is a financial advisor with Ameriprise, and he's been there for over 20 years in Alexandria. And Josh is also the board chair of our Alexandria Area Community Foundation. And he's raised in Alec, and so I'm happy to welcome Josh next. Turn it over to you, Josh.
Thank you, Holly. Well, it's a pleasure to be here talking to you about charitable gift annuities today. I've got kind of the unique perspective of both an advisor and the board chair. So I'll start with my thoughts on charitable gift annuities as an advisor. Since I started in this business in the late 90s, working with folks most of the time looking to retire, It's been a challenging time. We look at interest rates, as Brad mentioned, being low, and they've been low for a long time. We're in historically low rates. We've got a lot of questions about the market. We've got an extreme amount of market volatility in the last decade or so. Has been maybe a little more calm, but certainly in 08 and 09 and now where we're potentially headed. Certainly earlier this year, we had a lot of volatility and there's a lot of question marks. So when I talk to clients about planning and looking at retirement, we focus a lot about getting to know them. That's really where it needs to start, an in-depth relationship and conversation about what it is they want their money to do for them. And through that process, through those questions, what their goals are, their time frame, their risk tolerance, and again, where they want their money to ultimately go, we uncover if they're charitable or not. And if we haven't uncovered it in that conversation, I'll just flat out ask them, do you have charitable intentions or not? Usually that's kind of surfaced before that time, but if it hasn't, we want to be very specific with that. Because if I'm doing my job right and I'm asking the right questions and listening, if they're charitably inclined, then my job is to help them meet those goals of theirs. So the Community Foundation and the Charitable Gift Annuity is a great tool regarding that. So when I talk to clients looking to retire or early in retirement, a lot of the same themes have come up really since I started, and they're common and not in any specific order, but are we going to have enough money? Will we outlive our money? What are taxes going to do to our wealth? What are tax rates going to do in the future? What are the markets going to do? Are we going to run out of money? The same questions. How can we afford healthcare? What happens if inflation gets a lot higher? All the questions and concerns we would all have heading into retirement. It's kind of an uncharted territory. We've worked our whole lives. We've saved. Accumulation, although it's hard sometimes to save, but generally as far as your finances go, it's easier because you're accumulating, you're setting your money aside. If the markets are volatile and perform poorly, guess what? You still have an income coming in, you're still working, you still can add to it. You haven't made any final decisions yet. When it gets to retirement, now you look at the in-depth change that's occurring. You look at your tax, maybe one of you is working part-time or both of you. Do you start Social Security or not? What are the markets going to do? Are you going to outlive your money? All those things, they get pretty complicated pretty quick. And the taxation of those items at different times, all those things kind of come together really, really quickly. There's a lot of questions and concerns there. So as an advisor, the gift annuity conversation starts with if they're charitable or not. It needs to start with that. And if they are in that process, it checks a whole lot of the boxes that clients are concerned about. It's income they can't outlive, as Brad mentioned. It doesn't rely on the market. They don't have to worry about market volatility. It's paying them. Another conversation point that comes up a lot is we've got money at the bank, but we're not making anything on it. We don't want to invest it all because we might lose it, but we need income, Josh. So what do we do with that? Well, there's a way to create some income from those dollars, especially again in this low interest rate environment. And then we talked about, again, creating that wealth that they can't outlive. And as an advisor, when I talk to clients about that and I listen to these concerns, and these are people you get to know really well, you care about, and they've entrusted you with their finances. They're coming to you for advice. And when they're asking these questions, what are the markets going to do? Can I outlive my money? What are tax rates going to be? They're questions you can't answer as an advisor. If you're being honest with them, you don't know the answers. So we need to prepare and give them advice that they're comfortable with. And the gift annuity is certainly one that again checks those boxes. They gets rid of a lot of those concerns. It has to be money that doesn't need to be liquid, that they want income from. That's a long-term decision, as Brad said. You don't get redos, you don't get do-overs. But if it is that scenario, which oftentimes it is with those folks, if they're just looking for income to recreate that paycheck and they don't want to lose it in the market, that gift annuity is a great tool to use. So again, as an advisor, I look at it as a great substitute for a CD or cash that's sitting on the sidelines that didn't need to be liquid. It's just sitting there due to the fact that they're worried about losing it, and they don't need flexibility on it. So it's a great tool for that. I think it also lends itself to your credibility as an advisor and a professional. One, it shows that you have the knowledge of charitable gift annuities. and how they work, and that it's a good fit for that prospect or client who is charitably inclined and looking for income, who has those concerns we mentioned. You are referring them to an organization that does a great job. So anytime I can work with my clients closely with good attorneys, good accountants, and organizations like CommunityGiving, you lend yourself to credibility instantly. You've got that, which is a great thing as an advisor. You tighten that relationship with the client. You make yourself referable, I certainly think, because of that. And then also, when you show that you're looking out for the client's interests, you've listened to them and not your own as an advisor. You're doing with them, you're giving them advice what they want to do with your money, with their money. That's a really, really important part of this. So I think at the end of the day, that charitable gift annuity is a really, really easy conversation with the client. It's one they understand. It lets you get community giving involved again, which is a great, my aspect, my opinion, a great thing for the advisor. You get the attorney and the accountant involved, which is good. And also if they have children, you can get them involved. I just do multi-generational planning with the parents, grandparents, kids, get them all involved so they're all on the same page. They understand what went into this decision up front so no one can question it later. And they've got a really good, comfortable understanding of why it is you recommended that product for their parents and why it is community giving was a good fit for their charitable intentions. So as an advisor, those are all the reasons I like talking about charitable gift annuities. It's a great tool for us as an advisor to mention to those clients, again, for all the reasons we discussed. And then it also, again, opens some doors for continued discussion with other folks and other professional advisors. And I think that's good. It makes the foundation referable as well. So as a board chair, kind of segueing into that part of the conversation, I like it for that reason. It makes us referable. We give the client a product that crosses off, checks the boxes that they're concerned about. It's not market driven. They can't outlive it. It's tax advantaged, which is a big thing for a lot of these folks. There's a lot of pros to it. It also gives us the ability to introduce ourselves to so many people who haven't heard of us, because there's a lot of different products that community giving offers that makes us unique compared to a lot of organizations, a lot of charities that they maybe don't know about. And again, at the end of the day, if we're introducing these people to community giving, we're helping those people out, which is a win. I think as a professional advisor, it makes you look knowledgeable and creditable, which is certainly a win. And it helps the community you live in and you work in, along with these people, improve. That's why we're all here coming together to do good for the community. Together we're better. And I think this charitable gift annuity is just one additional way, one additional tool that we can use to market ourselves and to create knowledge about community giving and what it is we're doing and the great things we're doing, and hopefully get more people involved. Then I'll turn it over to Kathy, who'll talk a little bit about her experience as a client and or I shouldn't say client, but as her experience with someone who's participated with charitable gift annuities.
Thank you, Josh. I actually, this is Steve again, and I was going to do a very brief introduction of Kathy. So Kathy Allen, who I had the pleasure of working with several years ago, is just a wonderful individual within the local community in the greater St. Cloud area. She works as a consultant, and you can check her out at her website, KathleenAllen.com. She has written a wonderful book called Leading from the Roots, which I highly encourage people to read. But more than that, she just cares about her local community. And she started thinking about some of her charitable options a few years ago. And we started looking at some options for her. And we actually started with some of the charitable trusts. And the Charitable Remainder Annuity Trust is the one that Brad had mentioned. And in the end, it seemed like the gift annuity actually was a little simpler and was a little more straightforward. And so in the end, that's what we were able to create and work with Kathy to benefit her favorite charities. And we're delighted that she joined us today, and she's going to tell you a little bit about her story. So Kathy, turn it over to you.
Thanks, Steve. Wonderful to be here. So my story started with a conversation, a quarterly kind of financial review with my financial advisor, and we were looking at a few years ago the opportunity to add to my Roth IRA, which I'd kind of not been able to contribute to for a number of years. And so we were trying to figure out was given this kind of window of creating some rollovers into the Roth, if that was a good thing for me and my investment strategy going forward, and what the tax implications would be for me for that year. And as we kind of looked out over the scenarios, it seemed like maybe this would be an opportunity for me to balance out and minimize that tax liability that I would have had to pay by doing an offset with a charitable annuity gift. And so we looked at the different options, and I like the idea of an annuity because given my ongoing consulting income, it allows me to minimize what I need to withdraw from my retirement accounts, and it gives me an opportunity to provide more legacy gifts to my nieces and nephews and whatnot. And so it all kind of came together. I had good relationships with people who worked at CommunityGiving and the Central Minnesota Community Fund. So we began to talk about different options and what that looked like. And I just ended up doing a deferred gift annuity that year, and that minimized my tax implications for my rollover and minimized my taxes in general for that year, or not eliminated for sure, but minimized. So for me, one of the reasons why I found a community foundation to give to is because a number of my consulting clients are community foundations in various states across the country. And I've just been so impressed by the difference of having a strong community foundation in your community that entity makes on the community. It's not just about building a portfolio of business for community foundations. As they evolve and become stronger, they all have some kind of significant community impact. And I do a lot of work in rural Nebraska, and you can almost feel the difference in the community when they have an operating community fund that is focused on doing strategic grant making for those communities and helping them be more vital. So I've impressed significantly by the body of work, I guess you could say, of having people who live in a community and give back to the community foundation, and what that means for what I would call the active hope for the future that people who give to a community foundation have. Because when you either give through a legacy gift or a deferred gift annuity, what you're doing is you're saying, I believe in this community, and I believe this community will be around 20 years from now or 30 years from now, and that they will need discretionary resources to manifest and serve that community in a way that helps keep it vital and thriving and resilient. And I believe that that's an important kind of part of our way of thinking about retirement. It's not just about what can I get out of it, but it's also what can I give back. So that's kind of my story. I don't know what else you might want to know, so maybe we could go to stories or questions that might be a better way to pull out my story and my philosophy. In general, it's just another part of having a diversified portfolio for me. And this is a nice way to do it and also give back.
Well, thank you, Kathy. That is a spectacular way to showcase the way a partnership between a strong community foundation, strong professional advisors, and a donor with charitable intent, how that really works. So thanks so much for spotlighting that. I'm Sarah Carlson. I'm the Executive Director of the Wilmer Area Community Foundation, and I have the opportunity of facilitating the Q&A this afternoon. So the first question that is loaded into the Q&A tab has to do with the kinds of assets that can be donated into a charitable gift annuity. So Brad or Josh, would you want to answer if there's specific assets that are more beneficial to use in this application? There's a question about real property or shares of a closely held company.
Well, I can start with that. Notice the first question asks, can you donate real property to the community foundation for this? And the technical answer is yes. But as legal counsel for the community foundation, I would advise them against accepting that. And the reason is when we try to track the donor into a modified gift. The problem is that the real estate, there's no problem, or there's no legal reason why you can't donate any type of property for a gift annuity. But real estate's hard to sell sometimes, and if it's an immediate annuity, the foundation has to start making those payments right away. And if they have to start making payments before they distribute their real estate, then they're going to run into problems. So, and the same thing would be closely held stock. Anything that's hard to sell type of asset is not a good fit for a gift annuity. But there are other vehicles. So if somebody has real estate that they want to give to charity and they want to have a payment stream, what we would talk to Carol and Steve about recommending would be steer them into a charitable remainder annuity trust. Or no, charitable remainder unit trust. Annuity trust is just a single payment, same basic problem. But a unit trust, a CRUT, has some features that you can incorporate into it, particularly for real estate or closely held stock, where you don't have to make a payment out until you actually sell that asset. You only have to pay, sometimes you just pay the lower of the actual income or the 5 or 6%, whatever the percentage is on the CRUT. It's called a flip CRUT, and it's specifically designed for real estate. So it goes into the CRUT. The charity has a chance to sell it and then convert it. And once it converts to other liquid assets, then they start kicking in that percentage that gets paid out. So anyway, that's a long answer, but the answer is, well, we'd recommend against real estate or closely held stock into a gift annuity. But there are other vehicles that can be used and still get a payment stream back to the donor, where the charity doesn't have to take quite as much risk as they would if they have a gift annuity for real estate. So that's the answer on that question. And the other one, I think that was a question specifically to Josh, and it had to do with a very specific investment that I'm not familiar with, but I think the investment advisors would be. But if it's a publicly traded security, then there's no particular problem in getting it in. The charity can sell it, convert it to cash, and then they start the payment stream. So, Josh, do you want to give another answer to that stock question?
Well, yeah, I mean, I would just echo what Brad said. Usually if it's a technical question, he'd be the person I'd be calling anyway. So he was a great guy to answer that. But highly appreciated stock that is easily traded would be certainly something that I would talk to clients about and say, hey, tax-wise, this is a way to do some good with that, meet some of your income needs at the same time, which is great, and avoid some of the negative tax consequences. So that works well. Other items, if we see CDs, there's a ton of cash I've noticed in the last 5-6 years, especially sitting on the sidelines because people are worried, earning historically low rates, a lot of times next to nothing. And we're talking, sometimes it's tens of thousands, sometimes it's hundreds of thousands. I've even seen it where it's millions of dollars sitting there, earning nothing, doing nothing, because people are paralyzed with fear of stocks. They're also worried about bonds. So those types of investments or cash positions are easy when they don't need liquidity. They're just looking for something to do with it that they aren't going to lose on, or a way to create income from. That works really well. And then also, like Brad said, a individual stock that's easily traded. Those types of things are common products that I would talk to clients about, saying, hey, if you're charitably inclined, like we talked about, and you're looking for a way to create income you don't have to worry about, that gift annuity sounds like a good fit.
Thank you, Josh and Brad. I just wanted to share that the Wilmer Area Community Foundation has been the beneficiary of 8 different charitable gift annuities left by a single donor who had the same exact situation Josh was mentioning. He had assets tied in no return, either cash or in very low return CDs, and he was in his 80s, and someone in his professional community talked to him about a charitable gift annuity, and he was already charitably inclined. And by the time he was done liquidating those assets over time and converting them into a charitable gift annuity, he had 8 that benefited charities and the Wilmer Area Community Foundation at his passing to the tune of $1.2 million. So it changed the landscape of what happens in our community, and what our community foundation can actually be empowered to do on the ground when assets like that come in to benefit your work. So I would just echo that has been an immediate game changer for us in the Wilmer area. And when you have a donor like Marv or like Kathy, who are interested in those tools, we're very interested in having a conversation, not only about how they can use those assets, but how we can help protect their legacy for the long haul. Brad, the next question is for you, and it's in the chat, so you may not see it. Am I limited to 2 lives on a charitable gift annuity? And what if I want to disperse to more than 2 people?
Well, the answer is a charitable gift annuity is a very specifically statutory created document that is in fact limited to 2 lives. So if you want more lives than that, then you should be using one of these other vehicles, the Charitable Remainder Unit Trust or the Charitable Remainder Annuity Trust, because you can put more lives in those. They still have to meet that 10% charitable benefit at the end, but they don't have the kind of an arbitrary 2-life standard that a gift annuity does. So that's, unfortunately, the answer is you can't go to more than 2 lives on a gift annuity. If you had more than one person you wanted to benefit, if you don't, as Sarah was mentioning, a person with eight gift annuities, that the feature to that is you can only, each gift annuity is unique and it's for a particular contribution for particular people for a particular time. And if you want to put more money in later, you have to do another gift annuity. So you could do a separate gift annuity for different people. So if you have one person you want to benefit, or maybe you have 4 children that aren't too young so that you can meet the 10% standard, you could set up a separate gift annuity, one for donor and child 1, donor and child 2, donor and child 3. So you could do that. You do it with a series of gift annuities, or you put it into a charitable remainder annuity trust, where you could have multiple people, where it would continue for your life and then it could continue for your children's lives after that, provided it didn't fail the 10% test. So that's kind of a long answer, but you can only do 2 lives for each gift annuity.
Great, thank you, Brad. And I think you just answered the question about if a donor wanted to add to a CGA over time, how they would need to handle that. So Brad, could you just say a little something about testamentary gift annuities and how they might play into this scenario?
Well, you can, a gift annuity is a contract, and I suppose you can have that contract go into effect when you die under your trust or your will, or a beneficiary designation is getting funded at that time. You're not going to get a current income tax deduction because if it's coming testamentarily, it's coming on your death by definition. It'll be out of your estate perhaps for estate tax purposes, but you won't get an income tax. But you're giving it to people. So let's say it's a gift annuity for your spouse, and then to the charity to pay the income stream to the spouse. Well, you'll, like I had mentioned earlier, you won't have any estate tax on that. You won't get an income tax deduction because it's not happening during your lifetime, but you will not have to pay any estate tax on it because if it's going to a spouse, it'll be a marital deduction for that part, for his or her interest for that life, and then go to the to the charity. On the end, you get a charitable deduction for that. So it would work the same essentially, Sarah, except that you don't get the current income tax deduction because you're not pertinent with any money during your lifetime. Is there
Thank
another
you,
question?
Brad. I'm sorry, I was just pausing because I heard someone say something, so I was curious if Josh or one of my colleagues was going to ask a question. Okay.
Sarah, if I could add something, I think that having, it really was helpful for me to have a financial advisor who was connected to the community foundation in town and had a favorable impression of that as an organization. And, you know, sometimes financial advisors, when we do a charitable gift or deferred gift annuity, they no longer get to manage those funds. So you have to have some generosity and some perspective with your financial advisor, I think, to have this conversation with them and have them see the benefit to the community over time and help support you as an investor to make those choices and those decisions. So I was very lucky that my financial advisor appreciated what my charitable energy and wish, and honored that in this process of trying to figure out how to diversify the investment portfolio I was doing and how this could play into that.
Thank you, Kathy. We do have a couple more questions that have come into the Q&A feature, so I'll let our panelists get those up in front of them as well. But the first is, could this benefit two people that are not married? For example, if one of them has a lot of assets, but they don't want to get married, and this could be a way to help support the other person during their lifetime, or other estate gifting issues. Would this be a strategy to deploy, Brad? I think you're muted, Brad.
All right. Am I okay now?
Yes, you are.
All right. So as I had mentioned before, when you make a gift, there is a potential gift tax issue or estate tax issue, depending on that person, the other person that's receiving the gift annuity, because typically it's a donor doing a gift annuity for themselves or for their spouse. But in the question, it was you're doing a gift annuity for a non-spouse, whether it's a significant other or a child or a friend. But if you're not married, you don't get a marital deduction. So that person who's receiving that stream of payments has got a certain actuarial life expectancy, and there'll be a certain present value of that future stream of payments going to that person. And if the person doesn't qualify for the marital deduction, then it's going to be a taxable gift. If they've got a current interest in it, it probably will qualify for the annual exclusion, the $15,000. But to the extent that present value exceeds that, then there'll be a taxable gift to the donor, and they'll have to report it on a gift tax return. If it's made on death to a person that's not a spouse, then it'll be on the estate tax return, whatever that actuarial present value is of that stream of payments to that person. So there is a gift tax issue in doing it, but you do get it out of your estate ultimately. And whether you pay gift tax or estate tax will depend on the size of the estate. So I think that's the answer to that question. There was a second question that I saw. It looks like it says our gift annuities. Oh, there it is. Unrestricted funds for the foundation. Well, that's a little beyond my area, more onto the CPA area, but I think technically gift annuity money that comes in belongs to the foundation, and they don't have to be conservative. It is usually held by the foundation in reserve, or any charity in reserve accounts, because that's a prudent way of doing it. And I'm not sure if I'm not as familiar with FASB rules and the CPA rules to know whether technically it needs to be treated as unrestricted or restricted. But my understanding is the law, from a legal standpoint, does not require a reserve, but that from a practical standpoint, foundations will hold the money in reserve because they kind of want to know the money's there to support the annuity, even though they have to pay it one way or the other. So that's not a complete answer on that. I don't know whether Steve or Carol know the answer to that question.
I'll just chip in. It's Carl up in Brainerd. In that we just set up a charitable gift annuity for a couple who want to support one of the nonprofits in our community that has an agency fund with us. And so their charitable gift annuity remainder will be paid to that agency fund that they want to support.
But you wait and keep it in a reserve account until the person dies, and then the remainder goes into that agency fund?
Yes.
Correct.
Correct.
We would determine with the donor at the time that they set up this vehicle, what are their ultimate intentions, and make sure that if we needed fund agreements drafted to direct those assets accordingly. Usually, if we're involved, there needs to be a close benefit of some sort to the foundation for us to be the CGA holder. But in Marvado's case, he had gift annuities that benefited some unrestricted funds here at WACF, and then some that went into designated funds that support his favorite causes, and those were funded at his passing when the gift annuities matured. All right, so Brad, we have one more set of questions about the vehicle that Kathy introduced us to, the deferred charitable gift annuity. So could you talk just a little bit more about the benefits of a deferred gift annuity and who might be the best kind of candidates, or why would a donor elect to defer?
Okay, well, the deferred gift annuity obviously starts later. I mean, that's the difference versus an immediate annuity. And the people that I've seen use it sometimes are the younger people that maybe have trouble meeting that 10% standard. That if they took their money right now, or if they wanted a higher percentage than what that American gift annuity rate is, they're going to fail that 10% test. So as a general rule, it's kind of like a retirement fund. So you put your money in, let's say you put $100,000 into the foundation will keep it in reserve, but they aren't paying you yet. They're paying the contract that you write with them will have it paid at a certain time. So let's say you're 65 or 55 when you put it in, you have a little trouble with that 10% rule, or you simply want to deal with the deferred annuity concept, which is you put your $100,000 in when you're 55, and then when you're 65, they're going to start paying you a rate, and the rate is going to be higher than what you would have gotten if you started at 55. So you get the higher rate. So essentially the concept is you're putting your money with the charity. The charity is investing it. It's growing essentially tax-free. And then you start making this higher percentage and taking it out on a larger amount, presumably. But it's but the concept is the amount is set when you put in there. So let's say you're getting paid 6% instead of 4.5%. So that's your growth essentially, is that you're if it's 4.5% instead of $4,500 a year off the $100,000 gift, you're going to get 6% or $6,000 a year. So you're getting a bigger payment, and the concept is your money has been essentially growing, and you have this higher percentage you take out later, and you're not earning any income or paying any tax on any income in that interim because you haven't received anything. So once you start receiving it, then the same rules apply. It'll be partly ordinary income, part return of basis. But people that people that would use it would be younger ones that literally can't get an immediate annuity because they're too young, so they can get it later. But they want to give you the money now, and they'll get a current tax deduction now based on that, the difference between what they put in and what that future payment stream is for you.
Brad, in my situation, I just didn't really need the money when I started the gift annuity, and so I deferred it actually twice because as my business continues to grow, I don't really need the money, so I have it. I've given the gift, and I can access it at some point later on in my retirement journey.
Yeah. So it's kind of a retirement, it's kind of a supplemental tape retirement vehicle.
Well, thank you all very much for sharing your expertise. We really appreciate it. And I'm going to turn it over to my colleague, Carl Samp with the Brainerd Lakes Area Community Foundation.
Thank you, Sarah, and thank you, presenters, and thanks all of you who attended. We appreciate it very much. I just wanted to chip in another example of when a deferred gift annuity might work. I happen to have a board member whose husband is a professional athlete agent, and where you've got that situation of somebody in a very high income level at their younger years, but you know that will be going away at some point. So setting up a deferred charitable gift annuity can set them up later in life for an income stream. Plus, oftentimes these folks are setting up foundations. So if we can get them to set up a foundation within our within community giving, and then they could fund that foundation as well with the remainder from that down the road. And then on the testamentary charitable gift annuity, one of the things I heard is the advantage of replacing the stretch IRA. So for qualified funds that used to be paid out over the lifetime of the children, the heirs, now they have 10 years to collect that, so it can drive them into a higher income bracket. So a testamentary CGA can spread that those payments out to the heirs over their lifetime again. So just for that. So with that, once again, thank you so much for everybody attending today. Just want to give you a few announcements that we have. Just all the foundations have COVID response funds, and we're also shifting into recovery funds to broaden the scope of where we can give those dollars. So contact your local executive director to find out more information on that. We invite you to provide feedback to us and comments and ideas to any of the persons at the foundation. We'd appreciate that. And you can check our website out. If you go to plangiving.communitygiving.org, we have a lot of information on these. We actually have a calculator as well, so you can plug in the numbers to run for your clients or for if you're an individual on yourselves. So use those tools. We have some upcoming webinars. So on October 29th, we're going to be doing an estate planning workshop with a couple of the folks that are on our call today, Laura and Renee from Breen and Person. They're estate planning attorneys, and we've worked with them in the past. Renee's on my board of directors. And these are primarily for individuals, but we've also had professional advisors sit in on those as well. So Renee and Laura will be giving the kind of the legal aspect of it. And then we have an accountant who will be talking about the tax tips for estate planning. And then I'll be doing a quick summary on charitable giving in estate planning. We also have our continued webinar around diversity, equity, and inclusion. So we'll be doing equity and healthcare access next Tuesday, the 20th at 2. We have equity and education on November 10th and equity and banking and access to capital on November 17th. With that, we thank you again for coming, and look forward to seeing you again in the future. And if we can help you at all, don't hesitate to contact us. Thank you.